We're here with Eugene Fama, Sr. Most of you know he's Director of Research for Dimensional Fund Advisors, but haven't had necessarily the opportunity to hear him expound at length on a number of different topics. So we're taking this time here today to sit down with Gene and ask him some questions that we think most people will be interested in hearing the answers to. Gene, you were a football star, a French major earlier in your youth. How did you wind up in finance?
Well, that's a long story. You sure you want to hear it?
Sure.
Well, I was in my senior year at Tufts, and I was starting to recruit for a job. And there was a fellow in the French department there who was supposedly the best French PhD student in the country. And I asked him how much he made. And he said, I think it was like $5,000. This is back in the 19th century. I was getting offers at about $10,000 to go to work for company. And we had one child already, and I thought this probably wasn't my line of work. I was starting to get bored with it anyway. I had started to take economics courses, which I found more exciting. I mean, how many times can you go over Voltaire? It gets a little stale.
And when did you start teaching at Chicago?
1963. This is my 40th
year. Can you give us a
year.
flavor for what a finance curriculum for an MBA student would be like today compared to back then when you first started? What the big changes might have been, if any?
There was no finance curriculum when I started. If you go back to that point in time, 1963 is basically when the capital asset pricing model paper was published. 1958 was when Modigliani Miller was published, and 1959 was Markowitz's book. So none of that had worked its way into MBA curricula. And I went to Merton Miller when I was going to start to teach, and he said, we've given you a new number for a course. And I said, well, what do you want me to teach? And he said, that's why we hired you, is because none of us know what to teach. So you have to teach this new stuff that people are doing. And that's what I did. Before then, what's called the investments course was Graham and Dodd, believe it or not, security analysis. And there was no risk and return story anybody could really.
So you started teaching a finance course having never taken a finance course.
I had never taken one, right. That's the best way to do it, though. Don't want any predispositions on this stuff.
What is the Center for Research and Security Prices, CRSP as we call it? Can you give us some background, what the connection is between CRSP and Chicago and what your role there was? And
Merrill Lynch came to Jim Lorry in the 50s and said they wanted to know what the rate of return on stock was back to 1926. And he said, okay, we can do that for you. It was going to cost $250,000, which was real money in those days. And so they built the first version of this stock. It was NYSE stocks only at that point, going back to 1926, and came up with the number of what the value weight return on the market portfolio was, and it turned out to be within a few basis points of the S&P return, but it was an exact number. So that's how CRSP got started. But it turned into the basically the industry standard for quality data on stock returns.
Why is it generally unknown outside academic circles? Is it just
because they're terrible at writing programs that are accessible. So you have to be a Fortran programmer basically to use the file, or a C programmer. You can't be somebody who's got a mouse, you know? and that's about all they know about computers.
How did you first begin working with Dimensional Fund Advisors?
When Booth had the idea for the company, he called me in. We went to dinner, and he asked me to be on the board. So day one.
And did you ever expect it would be a decades-long relationship the way it's worked out?
At that point, the question was it going to be a month-long relationship? Going to be decades-long. Didn't have any money.
How does the relationship work now? You're a director of research, you're still a full-time professor at Chicago. Do you spend much time traveling out here? Do you do the research in Chicago and communicate it to Dimensional? Or?
Well, I never explicitly do research for the purpose of Dimensional. It's kind of the hope is that the research that I do, Ken and I do, will show up eventually as dimensional stuff or improvements in dimensional stuff. But you can't really set out to do that from the beginning. I don't know what I'm going to do tomorrow, so and I wouldn't do it any other way. If they want me to direct my research towards some specific thing, it's not going to work.
Turning to some of the research that you've done over the years, the value research that you and Ken French published in the early 1990s, can you give us a flavor for what the academic setting was at that time? What was the conventional wisdom, if there was any, about what the value effect was, if any, and how was your research received at that time?
Well, that paper, there's really, the paper that got so much attention, there's nothing new in it. Each piece had appeared somewhere in some paper, but hadn't gotten much attention from each one on its own looked like a problem with the CAPM, but it was just one problem. And somehow we put it all together, and putting it together, people said, gee, this thing just doesn't work. And it got a lot of attention. The 92 paper is by far the most highly cited paper in finance of the last 20 years. So you never know about these things. At the time, we didn't think it was such a big deal. But it caught the fancy of the investment community immediately. I mean, the paper wasn't even published, and pension fund manager came to my office and looked at the numbers on my screen and said, "That looks like an investment product to me," and bought it. And started the small value and the large value products right at that point. And speak value and growth. I mean, we didn't invent those names. I think they're terrible names. The value part of it anyway, but that's kind of standard industry dimensions of investing now. It's not just.
If you had your choice to go back and relabel them,
we didn't put that label on it. That word doesn't appear in any of our initial papers. You won't find.
How would you prefer to refer to it?
I don't know. High book to market, low book to market.
Is it would be fair to say that the value work has had perhaps an even greater impact on the investment side than on the finance curriculum at MBA schools? I mean, do they still teach the CAPM in finance courses?
People still teach the CAPM because it's a very easy model to teach. And it's also the rudimentary ideas of the CAPM and multi-factor models are really the same. So starting with the CAPM is still a good idea. I still do that. The logic of it is still good, and the multi-factor logic is just an extension of that logic. So it's a good setup. But I think pretty generally now people would teach something about multi-factor models and would show some of the Fama French research in MBA level courses. Certainly in PhD level courses they would.
Turning to the fixed income side of the spectrum, is it true that the first fixed income strategy that you developed for Dimensional was called the Inflation Hedge Fund?
That was the original name, right?
When was that?
That was right off, very soon after we started. The initial idea was a small stock fund. David thought that pension plans didn't have enough exposure to small stocks. And it was kind of serendipity that right at that time the papers on the small stock effect got published. But I don't think that was his original motivation. His original motivation was simply that this was a segment of the market that people didn't buy, so it looked like a business opportunity. So that's how the firm started. And then I was talking to them about the term structure work that I was doing, the bond market stuff, and they kind of liked the sound of it. And at that time, it was directed towards, the research had a lot to do with how good short-term fixed income is as a hedge against inflation. So when we came out with the product, it was called an inflation hedge fund, because that was the idea was that it would be short-term, and it was going to provide a pretty stable real return and give you a hedge against inflation. But from a marketing perspective, the title just didn't click with people. And inflation went down, so I don't know if people lost interest in that title. And when I had done my original work, if you look at nominal interest rates, they're basically two pieces. There's a real return and there's an expected inflation rate. Well, in the original work, the variation in the real return wasn't so high, so most of the variation in nominal interest rates was expected inflation. But then, as time passed, the real part got more variable, so that title kind of lost its meaning. But it's still true that short-term fixed income instruments are a very good hedge against inflation.
How should somebody think about that 1 year, what we now call the 1 year fixed income strategy, compared to intermediate or longer term inflation indexed bonds?
They're not the same. I think the inflation index bonds are great, but basically they're giving you a hedge against inflation, but because the maturity of the instrument is very long, they're not giving you a hedge against changes in the real interest rate, that part of the picture. So there's still lots of uncertainty about the returns on these things because the real interest rate does vary through time. And there's no way to write a hedge against.
Meaning if real rates rise, these could suffer?
These things suffer, right. They go down in price. They've had a good run for the past few years, basically because real rates have fallen dramatically.
Some people cite your research showing that value in small firms have higher average returns over time, and they assume that you would recommend most investors have a big helping of small and value stocks in their portfolios. Is that a fair representation of your views?
No. Basically, this is a risk story, the way we tell it. So there is no optimal portfolio. The way I like to talk about it when I give presentations for DFA or other people is, in every asset pricing model, the market portfolio is always an efficient portfolio. It's always a relevant portfolio for an investor to hold. And investors can decide to tilt away from that based on their personal tastes. But that's what it amounts to. You can decide to tilt towards more value or smaller size based on your tastes for these dimensions of risk, but you needn't do it. You could also decide to go the other way. You could look at the premiums and say, no, I think I like the growth stocks better. And as long as you get a diversified portfolio of them, I can't argue with that either. So there's a whole multi-dimensional continuum here of efficient portfolios that anybody can decide to buy that I can't quarrel with. And I have no recommendations about because I think it's totally a matter of taste. If you eat oranges and I eat apples, I can't really quarrel very much with that.
So there is no perfect portfolio?
No. The good news is there's a continuum of them, which means there's an infinite number.
Sorting stocks on the book-to-market ratio appears to proxy for some kind of risk. What is this risk? Why can't we get rid of it just by diversifying into a large portfolio?
Well, that was the original idea of the idea that you could get rid of it was one of the original counters to the Fama French research. This looked like an arbitrage opportunity, which means if you buy enough of these things, if you go long the value stocks and go short the growth stocks, you'll end up with a portfolio that has no variance. Well, it turns out that's not true. The variance of that difference is basically our HML risk factor, and it has its variance is on the order of that of the market. So you can't diversify this away. Both ends of that portfolio include everything you can buy in those asset classes. So we are diversifying, and it doesn't go away. So there's something about the co-movement or the co-variation in these returns that you just can't get rid of.
But that's the sign it's a true risk factor then?
It's a sign of a true risk factor, right. Exactly.
What about momentum? Is there momentum in stock prices? And if there is that evidence of some kind of market inefficiency?
Well, there is momentum in the historical data. There's definitely momentum in the U.S. historical data. The only market that doesn't show any momentum effect is the Japanese market. That used to be 40% of the total. Now it's much less. When it was 40% of the total, I used to say, well, there's momentum, but there's at least one big place where there isn't momentum. Now you can't say that so much anymore. I think momentum, at least in the historical data, is a real phenomenon. The problem is that it's not a tradable kind of investment strategy in the sense that if you really wanted to take advantage of have a momentum portfolio, you'd be turning it over every month. And that's the costs are going to quickly outweigh any benefits that you can get. What really bugs me about it, though, bugs me in the intellectual sense. I really don't care otherwise. But what really bugs me about it is, by almost everybody is purported to be a momentum investor. Almost everybody is purported to be a follower of patterns in the market. And if that were the case, there wouldn't be any momentum effect. So the real puzzle is, how can there be a momentum effect in a world where almost everybody's a momentum investor? It's the contrarians that are kind of unusual, at least in the typical story people tell about investment.
If you had to advise investors, not that you are, but if you had to, what are the key issues investors should focus on in building a portfolio?
Well, I mean, you know my views on this quite well. We can throw active passive aside right away. Actually, Ken has a great story, and he licensed me to tell it, to steal it. I'll say tell it instead of steal it, but that's what I'm doing. He says, who is the greatest stock picker of all time, or at least one of the greatest stock pickers of all time? Peter Lynch. He was the manager, or the portfolio manager of the Magellan Fund during its heyday. You would think that person would be the best person to pick a successor and train a successor, but doesn't seem to have been very good at it, in the sense that that fund really hasn't done very well since he left it. So if the best person, the best stock picker of all time, can't train his successors, what could a poor person like me do in training these MBA students? It's not credible that any of my colleagues can train MBA students to pick stocks. It's just not credible. They can't do it. They don't know anything about that themselves. So how can they train somebody to do it? How do you pick it up? I don't understand this process. But in any case, the evidence is quite clear. If you do any systematic analysis of investment performance, what you find is people basically get return for risk, and then from that you subtract fees and expenses. So it's the cost that basically determine differentials in portfolio performance. Active managers charge more, so they tend to do worse. But that doesn't mean people will stop doing it, especially MBA students. All the ones that want to be portfolio managers aspire to be active managers naturally, since if they're lucky and they win, they'll end up rich. And it's very, very, very attractive to them. So lots of the students in my class even end up as active portfolio managers. I don't know where they learn how to do it, though.
So the message to investors is diversify, focus
Yeah, the message.
on
All right, I
simple
didn't give you the positive side of the answer. The evidence is also clear that what does matter in investment portfolio strategies is asset allocation. The choice of stocks versus bonds, and then within stocks, are you going to tilt towards value, or are you going to tilt towards small? But no, those are basically the decisions that you face. Plus, international diversification is another aspect of it. But asset class allocation is very important.
So the good news is there are only a couple of big key questions you have to focus on, and ignore almost everything else.
Right.
How do you do your research? Do you set aside a few hours every day or a few key days a month? How does it work?
I'm very disciplined, actually. I've always worked this way. I get up very early in the morning.
How early is early?
5 o'clock. I'm usually here. When I'm in California, I'm usually, or even in Chicago, I'm working at least by 6:30, and I'll work. I used to think you had to put in a whole day, but through time, as I got older, I realized that your marginal product goes down very rapidly with the hours that you put in. So now I've given up. I work until maybe 1 o'clock, and then I go play golf or tennis or go windsurfing. So this is a lifestyle that suits me. But I do this 7 days a week. I've always worked 7 days a week. My little mind can't retain things if I take a day off.
With so many research papers on so many topics being published these days in so many journals, how do you decide what to focus on?
I'm very bad on that. I don't compulsively read journals. Lots of people do. I only read articles that are pertinent to the stuff I'm currently working on. My interest just doesn't... My focus is very good on the things that I'm working on. It's terrible on the things that I'm not working on. So if I see something that relates to what I'm doing, I'll read it avidly. If the other stuff I won't even look at.
How do you get research ideas that motivate you to focus on these things?
Boy, that's a good question. It just happens. I've never had a research program or a program of ideas saying I'm going to work on that 2 years from now. I don't know what I'll be doing. I've never known what I'll be doing 2 years from now. I used to worry about that when I was younger, that 2 years from now I may not have any ideas. But it didn't work out that way, so I stopped worrying about it after a few years.
So maybe it's safe to say that I already know the answer to your next question, which is if you were trying to advise a recently minted finance PhD, where should he be directing his or her efforts over the next 10 or 20 years? Any ideas where the most fruitful areas of research might lie?
No. Yeah, George Stigler, who was one of my colleagues, always said, if somebody asks you a question like that, be suspicious of them. They're probably somebody you don't want to hire. If they don't have their own ideas and really are skeptical of yours, they probably don't belong here. So we never give advice to the young people.
Any plans to ever stop teaching or stop researching?
No, I wouldn't know what to do. I'll always be doing research. I don't know what else to do. I enjoy it. I mean, I would do it even if people didn't pay me to do it.
Gene, thank you very much for your time today. It's been very helpful.
My pleasure.